Welcome to the Deep Dive. Today, we are taking a rapid but really rigorous look at the Q3 2025 earnings call for 1stdibs.com Inc. That's ticker DIBS, the high-end marketplace for luxury, design, and art.
And this deep dive is, I think, absolutely essential. This quarter fundamentally changed the entire investment thesis for DIBS.
It really did.
Yeah, the earnings call, which happened pre-market on November 7th, it just confirmed that management had finally delivered on the financial discipline the market had been craving. And the result was, a massive rally.
A huge rally. And our mission here is to move past that immediate stock pop and really understand the strategic decisions, the numbers that prove this was a genuine inflection point.
Exactly. They've shifted the whole conversation. It's not, can they ever be profitable anymore?
Right. Now it's, okay, when does the free cash flow start? So let's unpack the numbers that actually kick off that change.
Well, you saw two main things drive that initial positive reaction. First, revenue came in at $22 million.
Okay.
That slightly beat the consensus, which is around $21.5 million, so 4% growth year over year.
Not bad. And the second part?
The second was GAAP EPS. It showed a pretty tight loss of negative 10 cents, which, again, beat the consensus loss. That was closer to negative 13 cents.
And as you know, a company like DEPS, one that's in this kind of transition, it's not really traded on GAAP EPS.
Not at all.
It's all about the path to margin expansion, to sustainability.
Yeah.
And that path runs directly through one critical metric, adjusted EBITDA.
Precisely. This is the core structural story here. The adjusted EBITDA showed just a dramatic improvement, swinging from a loss of $3 million a year ago,
just 12 months ago,
to a loss of only $200,000 this quarter. That improvement catapulted the margin from, negative 14.1% to negative 1.1%?
That is, to put it into context, the best margin performance the company has ever reported since its IPO.
Ever. It's enormous operating leverage captured in just 1 year. And the gross profit metric, it really underscores that whole efficiency story.
It has to.
It really does. Gross margin expanded to 74.3%. That's an improvement of 330 basis points year over year.
Wow.
Gross profit came in at $16.3 million. So the clear takeaway here is management was not chasing blistering top-line growth this quarter. Not at all.
No. They were focused entirely on proving out the model, the structural profitability.
Yeah.
And the market immediately, re-rated the stock based on that execution.
It seems like they deliberately traded volume for ticket size to get those margins. I mean, you don't get 330 basis points of margin expansion without making some hard trade-offs.
For sure. So what did they have to accept? What did that cost them in terms of, say, seller count or order volume to get these better economics?
Well, they accepted less volume and a smaller, more curated group of sellers. GMV, gross merchandise volume, that came in at $89.1 million.
Which was at the high end of their guidance, right?
Yeah, right at the high end, growing 5% year over year. But the trade-off was obvious. Total order volume was down 4%, and the unique seller count, that dropped by 17%.
Okay, so if overall order volume and the number of sellers are shrinking, how did GMV still manage to grow 5%? That's the key question.
The compensating factor was that strategic focus on the affluent buyer. The average order value, or AOV, it surged 10% this quarter.
10%.
10%. It climbed to nearly $2,700. So this shows a very deliberate tilt toward higher ticket, higher value transactions. They're focusing on quality buyers who are spending much more per order.
So quality over quantity, that confirms the strategy. With that focus on efficiency and AOV, how do they translate that into the actual expense structure?
Yeah.
Management really hammered home this message of cost discipline.
Yeah, the biggest driver there was what they called the September strategic realignment. Management said pretty explicitly that this realignment structurally lowered their GMV break-even point by roughly $250 million.
Wait, say that again. $250 million.
$250 million. Think about that. They need $250 million less in annual sales to hit profitability than they did before. And this shift came from, a multi-pronged approach. Headcount cuts, tightening performance marketing spend, and renegotiating with vendors.
And with those savings, they didn't just bank it. They reallocated that capital pretty drastically.
Let's talk about that pivot to product and engineering. It sounds like that's the core of the company now.
It's a really profound shift. They're making a high conviction bet on technology-led growth instead of just expensive paid ads. They noted that product and engineering roles now represent about 50% of their total headcount.
Half the company.
It's half the company. It just fundamentally reorients the organization toward scalable, high ROI tech development, which, has high fixed costs, but very low variable costs.
And speaking of marketing efficiency, that discipline is showing up very clearly in their traffic health.
Absolutely. Over 75% of their total traffic is now organic.
That's up 3 percentage points year over year. And this is not an accident. It's a direct result of them tightening the efficiency thresholds for their paid marketing. They're accepting a bit less traffic overall in exchange for much healthier unit economics.
Relying on the brand to do the heavy lifting.
Exactly. The 1stdibs brand drives that high-intent organic traffic.
And that tech investment, it also leans heavily on AI, which is a key differentiator. What did they specifically highlight about their AI usage?
They're using it for both internal speed and external buyer trust. Internally, management estimated that over 25% of all new code is now being assisted or generated by AI models.
That's incredible.
It directly accelerates their product development, right?
Yeah.
It makes that 50% R&D investment much, much more potent.
And what about externally? I think there was a specific product feature they highlighted to build trust with buyers.
Yes, the automated price parity enforcement mechanism. In the luxury space, trust is everything. This system ensures that items on the platform are priced at or below competing sites.
Which is vital for confidence.
Management explicitly linked this automated enforcement to measurable increases in buyer conversion in their pilot data. So it's already working.
That's a clear focus on the buyer. But what about the supply side? How healthy is that, especially with that 17% drop in sellers?
Management was quick to frame that as a structural cleanup. They confirmed the reduction was isolated to low-impact sellers, so it had a minimal financial drag on listings or GMV.
So it's like strategic pruning, just removing noise.
Exactly. And crucially, they also rolled out a new monetization move, a seller subscription price increase effective October 1st. This is their first broad increase for this segment since 2019.
And that tells you two things. One, essential sellers see the platform as a necessary channel.
They have to be there.
And two, it provides a tangible, high-margin recurring revenue tailwind that we should see hit immediately in Q4.
It absolutely does. And that brings us to the forward-looking context, guidance. The market was looking ahead, and what management guided for was, well, it was the definitive moment.
Okay, let's look at Q4 guidance. GMV is set between 90 and 96 million. That implies a range from, -5% to +2% year over year. Net revenue, 22.3 to 23.5 million.
Right.
But the major milestone, the thing that cemented the stock reaction, was the adjusted EBITDA margin guidance.
Yes. Adjusted EBITDA margin is guided to be +2 to 5%. This is no longer about narrowing losses. This is the company's first ever guided quarter of positive adjusted EBITDA.
It validates everything. It proves the structural changes, that $250 million break-even reduction. It proves it's permanent.
It's permanent, not temporary. And they were very clear about the long-term plan, too. They explicitly reiterated that they expect positive adjusted EBITDA for the full year 2026.
Which should lead directly to generating free cash flow.
Exactly. It gives investors a clear, executable roadmap. And on top of that, the balance sheet is exceptionally strong. They have around $93 million in cash and equivalents.
And no debt to speak of.
No highlighted debt, which gives them serious optionality.
And they're using that optionality to signal conviction to the market.
Exactly right. The board authorized a new $12 million share repurchase authorization. That is a clear signal from management saying, we believe our stock is cheap compared to its future free cash flow potential.
And the market definitely heard that signal. On the day of the call, November 7th, the stock gained, 15.5%?
15.5% on volume. That was 6 times the average. It was a decisive confirmation. And when you zoom out, DBs has massively outperformed the S&P 500 and the whole consumer discretionary sector recently.
It really reflects the market's preference right now for these disciplined, margin-first stories.
The market loves this narrative, but, what's the forward opportunity? Let's transition to our segment where we think through an outrageous but plausible trade idea based on the shift. And of course, this is definitely not financial advice.
Let's hear it. How do you play this transition to free cash flow with leverage?
So the core thesis is this. The transition to Q4 positive adjusted EBITDA is now priced in. The market expects it. The true re-rating catalyst, though, will be the move from adjusted EBITDA to generating verifiable positive free cash flow, which they expect sometime in 2026.
So you're betting on the market changing how it values the stock once that FCF is proven.
Exactly. The company is still being valued like a distressed, low-growth name, so the trade would be a long position using long-dated, deep-in-the-money call options, maybe options expiring in late 2026.
Okay.
The bet is that once FCF generation is confirmed, the market stops judging EBITDA on low single-digit GMV growth and instead assigns it a forward price to earnings or price to FCF multiple, typical of these resilient, profitable marketplace platforms.
And that multiple expansion off the currently depressed base could be enormous.
It could be significant. And what makes this plausible is the capital structure. You've got this massive safety net under the trade, that $93 million cash pile, and no debt.
Plus the buyback.
Plus the explicit $12 million buyback, which reinforces that safety net. It sets a credible floor under the stock. So it's basically a high-leverage bet on their operational discipline finally getting rewarded with multiple normalization.
A bet on management executing the plan, backed by a fortress balance sheet. It's a compelling, high-risk thesis to analyze.
And as always, purely for educational thought experiments.
That's a phenomenal breakdown. To quickly recap our deep dive into the DB's Q3 earnings, management successfully completed a multi-year effort. The result: their best margins ever, a structurally lower break-even point, and a clear, guided path to sustained profitability starting next quarter.
The shift from cash burn to capital efficiency is, I think, complete and validated. But now, the new and frankly more complex question for you to consider is this. Will that heavy investment in AI and product, which is now 50% of their entire headcount, will it be potent enough to reignite accelerating GMV growth without sacrificing these hard-won margin gains?
That balancing act, that is the true test for 2026.
It's the ultimate test of their new product-led strategy.
Something for you to certainly mull over. Thank you for joining us for this deep dive. We'll catch you next time.